Now let's discuss a few rules with regards to VAT. Like when it comes to output and input VAT, usually what we do is on all sales, we charge output VAT. On all purchases, expenses, we charge input VAT. Now let's look at some special rules. Capital items, like be it capital items or revenue items, or like if you're buying a machinery, is there an input VAT? Yes, we can claim input VAT. Goods for own use. If you're taking goods for own use, there is an output VAT on the replacement cost. With regards to purchase and sale of motor car, only if they are used 100% for business purpose, we can actually claim input VAT or charge output VAT if you're selling it. Remember, 100% business use. There must be 100% business use. Okay, 100% business use, only then we can. What about motor expenses? Motor expenses, irrespective of, like, if there is both business and private use, it does not matter. We can claim input VAT. So can claim input VAT irrespective of use. Like, is it private use, business use, does not matter. We can still claim all the input VAT. Now, entertainment expenses, remember, now always in your house, when guests come, they are given the first priority than you. Similarly, when it comes to UK customers and overseas customers, we can claim input VAT on the overseas customers, but not on the UK customers. All right. Then private use expenses, can we claim input VAT? No. Now, with regards to motor expenses, one expense that could come up is fuel. And with regards to fuel, if there is a private charge, if there's a private expense on it, then usually what happens is we can actually claim the input VAT on that, but the output VAT, we can charge them using a fixed amount called a fuel scale charge. So in the question, they'll give you the fuel amount, the private use of the fuel amount. So what you do is we can claim input VAT on that because you incurred that cost for them. So you can claim input VAT on that and you can charge output VAT. But how do you do that? Using a fuel scale charge, the amount will be given in the question, that amount multiplied by 20%, or 20 by 1 by 20, whatever is the right way to do it. Another very important point regards relief for impairment loss is, if an impairment loss, now what is an impairment loss? It's like a bad debt. Now, usually it's an input VAT. We can claim input VAT. When can we claim input VAT? In this quarter. So we can claim input VAT if, so when can we claim input VAT? If the time period, I'm telling you time period between two dates. Okay, what are these two dates? Due date of impairment loss, yeah, the due date, and the quarter end. Okay, the time period between both of this must be at least 6 months, at least 6 months or more than that. If it's less than 6 months, we cannot claim in this quarter. Time period between the impairment loss due date as well as the quarter ending, whichever quarter we are in, that quarter ending, they must be at least 6 months, and then we can claim input VAT on these impairment losses. Now, this is an important area, that is, go through this and see on the VAT invoice, like the MCQs to come, which are the following items appear on the VAT invoice. So just go through these, what all are the aspects coming in the VAT invoice. There's something called as a simplified VAT invoice. Take a look at what all things come in the simplified VAT invoice. What all can you see there? We can see supplier's name, supplier's name, address and registration number, date of supply, description of the goods, rate of VAT, total amount chargeable including VAT. Now, how long must VAT records be kept? 6 years. And what all things include in these VAT records? Take a look at those points. Right, now coming to something called as a default surcharge liability. Now, what is a default? Now, what is a default surcharge liability? It's kind of like a penalty for paying your VAT late. It comes in two situations. What are those two situations? Let's talk about those two situations. What are those two situations? When does a default surcharge liability arise? Yeah, it arises when you submit your VAT return late. Okay, you submit your VAT return late, or if you pay your VAT late, pay VAT late. In these two situations, a default surcharge liability works. How does it work? Now, you know very well some people, if you do something wrong to them, like let's say your parents, they give you one warning. They don't do anything, the one warning, but they tell you, this is a warning. Again, if you do, you will get screwed. So same like that. When first time we make a mistake, what the tax authority says, they give you a notice. So what in the first default, okay, in the first default, what happens is they give you a notice. Okay, they'll give you a notice telling you that you did this default and all that. And then what they do is a 12 months anniversary time they'll give you. 12 months anniversary. What is this 12 months anniversary? Let's discuss. It's like, let's say that you made this VAT payment late on 7th April 2020. They are saying that within 12 months anniversary. So first they'll give you a notice on that and then say, so 7th month, April 2021, you made a late one. No. So they are telling you within 7th April 2022, if you again make another one, you will have a penalty. Okay, so what is that? This is called a surcharge liability period. And also there is a notice. They'll give you a notice and a surcharge liability period. That is, they're giving you a warning in a 12 months time from today. If you're doing another defaulting, you'll have to start paying tax. Now let's say in that 12 months period, this person again defaulted. So you see the percentage is given here. First default in that period is 2%, then 5, 10, and 15. So go through these. And I'll tell you one question in the revision kit that helps you revise with surcharge liability. There is one question in your revision kit, VAT, but it is called Jogger Limited. Okay, it is called Jogger Limited. Jogger Limited. So to understand this properly, default surcharge liability properly, do this question Jogger Limited. Now coming to another peer area, that is when it comes to imports, exports, acquisition, and dispatches, what is the treatment with regard to VAT? Let's take a look. Okay, now if you're trading outside EU, outside European Union, it's called an import, and it's called import and export. Let's take it, what happens at that point. Now, if the trade is happening outside EU and if it is an export, now you're exporting outside EU, it is treated as a zero-rated sale. How does that make sense? You're exporting outside to encourage exports. There is no VAT on that. What about imports? If you're importing from outside the EU, that is you're a businessman in the UK, you're importing something from outside the European Union. In such case, it's treated as a normal purchase. Like usually you'd claim your input VAT. We can reclaim it in the next quarter. Now let's talk about trading within the EU with regards to sales and purchases. With regards to sales within EU, if it is to a VAT registered customer, it's a zero rated sale. But if it is a non-VAT registered customer, it's a standard rated sale. You can start charge any percentage. With regards to purchases, remember there is both input and output VAT. So the effect is neutral. Okay, so the effect is actually neutral when there is both input and output VAT. Effect is that VAT is neutral. Now I've given you the tax point over there, so we just go through that. Now, what about services? When it comes to services, how do we account for it? Now, place of supply in the case of services are deemed to be the place of the customer itself. Yeah, it's the place where the customer is established. Now, if it's a UK VAT registered trader and they are supplied with services from another country, place of supply is deemed to be the UK. The UK trader accounts for output VAT of the supply, equivalent amount is input VAT for the supply, so transactions usually neutral. Yeah. Now, these 3 points which I'm going to share are quite important. Now, all these accounting schemes are quite different from the usual way of doing your VAT accounting. Usually what you do is you prepare VAT every quarter and you pay it like 1 month and 7 days. Now, there is this cash accounting scheme. Now, the specialty of cash accounting scheme is you only have to record what you received and what you paid, not anything else. So there is automatic impairment loss relief. One of the advantages is there is automatic impairment loss relief. Okay, then when can you join and when can you leave? When your VAT exclusive turnover, yeah, VAT exclusive turnover, if it is not greater than pound 1.35 million, and you should leave once your VAT exclusive turnover is greater than pound 1.6 million. You can join when your taxable supplies don't exceed 1.35 million, but you should leave once it exceeds 1.6 million. That is because with regard to cash accounting scheme. Now, annual accounting scheme, pay attention to what all you need to study. First is a joining and leaving. So when can you join and when can you leave? It's exactly the same thing with regards to cash accounting scheme. Joining and leaving amounts the same 1.35, 1.6 million. Now, what is this annual accounting scheme? The whole point of annual accounting scheme is instead of making 4 returns, make just 1 return. And in that 1 return, you're paying like I'll tell you now. I'll tell you how the payments with regards to annual accounting scheme work. That is something you need to actually understand. So you have to keep note of the joining and leaving. I'm not writing that because already in the previous few minutes I had discussed that. Now, how it works is, let's say for the year ended 31st December 2021, what happens is, starting from 4th month, you'll start paying VAT. Starting from 4th month, you will pay, like starting from 4th month, you will pay 90% of previous year's VAT liability divided by 9. Each payment will be 90% of previous year's VAT liability divided by 9. And then what happens is, within two months, that is, you're starting to pay the VAT based on last year's liability, and within 2 months, within 2 months of this date, that is within this end date, as in within February end, this person should pay the balance, any balance. Like by December 2021, you know how much was the actual VAT liability. So if anything is there to extra pay, they should pay the balance within 2 months. This is how annual accounting scheme works. So learn the joining, leaving rules, and also the advantages and disadvantages. Advantages and disadvantages, you can go through your. So I'll tell you, it's like you only need to do one VAT return, and you can manage cash flow more accurately. You don't need to do quarterly calculations. Disadvantages are that, you actually need to predict your future cash flow sometimes, and the timing of payments have very less relation to turnovers. And the payments, like this POA we are doing based on previous year's VAT liability, which does not really reflect this year's VAT liability. So take a look, pay attention to joining, leaving, the calculation, and the advantage, disadvantage. Quite important. Then flat rate accounting scheme is the difference in the amount. Okay, it's not the same. So join, leave. Yeah, let's take a look. Okay, so we can join if our VAT exclusive, okay, if our VAT exclusive taxable turnover does not exceed, is not greater than pound 150,000. So the amount is 150,000. And when should you leave? When should you actually leave? If the VAT inclusive turnover, when the annual VAT inclusive turnover is actually greater than pound 230,000, then you should actually leave the scheme. Now, how does flat rate accounting scheme work? I'll tell you. Now, usually when we pay VAT, it's like output VAT minus input VAT. But under the flat rate scheme, VAT is equal to a percentage will be given to you in the exam. That percentage multiplied by tax inclusive or VAT inclusive turnover. That is our total sales. Add up all the total sales, along with that add the VAT also, that amount into the percentage given the question will give you your VAT. This is with regards to flat rate accounting schemes. These 3 schemes have a very good idea how it works, advantages, disadvantages for all 3 of them. All right. So these are some of the important aspects to keep in your mind with regards to the chapter VAT.